Today, we're going to talk about something that sounds a little, dry and technical, but is actually one of the most powerful and sometimes most dangerous tools in all of accounting. It's called accrued income. Honestly, it's the secret behind how companies report their performance, and once you get it, you'll be able to spot the difference between a company's real success and just a financial illusion.
So let me ask you this. How is it even possible for a company to announce these incredible, record-breaking profits? You see their stock price just soaring, but behind the scenes, they're quietly running out of the actual cash they need to survive. It seems like a paradox, right? Well, the answer, in so many cases, is hiding in the gap between earning money and actually getting paid.
All right, so here's our game plan. We're going to break down earning versus getting paid. Then we'll peek inside the accountant's toolkit to see the rules they play by. After that, we'll learn how to spot what I call phantom profits. We've got a great real-world story about pulled sales, and we'll wrap it all up with how you can use this to become a much sharper financial thinker.
Okay, first things first. The absolute heart of modern accounting is built on this one crucial idea. Doing the work is not the same thing as having cash in the bank. And accrued income? Well, that's the concept that sits right in the middle of that gap.
So what is it exactly? Simply put, accrued income is money that a company has earned. They've delivered the product, they've performed the service, but here's the kicker. They haven't even sent the invoice yet. Think of it like a confirmed IOU, but the official bill just hasn't been mailed out.
Now, this table is super helpful because it really clears things up. You've got accrued income, that's step one. You've done the work but haven't billed yet. The moment you send that invoice, poof, it transforms into an account receivable. And then you've got deferred income, which is the total opposite. That's when a customer pays you upfront for something you haven't even done yet. And that's the trigger point, right here. The single action that turns one thing into another is just sending the bill. Before the invoice goes out, it's a right to bill for work you've already completed. After it's sent, it's a formal, legal claim for cash. That little piece of paper changes everything.
So you might be wondering, why do accountants even bother with all this? I mean, why not just count the cash as it comes in? Well, it's because they follow a really strict set of rules that are designed to give a true and fair picture of how a company is actually performing, not just how much cash it collected this month.
And it all comes down to these two pillars. The revenue recognition principle basically says, look, you should count the income when you do the work, because that's when you actually created the value. Then the matching principle comes in and says, and by the way, all the costs you had to pay to do that work, like salaries, should be reported in the very same period. If you didn't do this, you'd get a totally warped picture of the business.
Now, to make sure everybody's playing by the same rule book, regulators created this global standard called ASC 606. It's basically a single, unified framework that tells every company exactly how and when they're allowed to recognize their revenue. It's a huge deal because it replaced this old, confusing patchwork of rules that were different for every industry. And this standard breaks everything down into 5 really logical steps. It forces a company to first find the contract, then figure out every single distinct promise they made to the customer, then put a price on it, spread that price across all the promises, and finally, and this is the important part, only recognize the revenue as each of those promises is kept. It's a very disciplined process. Under this new standard, what we used to call accrued income is now often called a contract asset. And this isn't just new jargon for the sake of it. A contract asset carries performance risk. That's the risk that your company might not finish the next part of the job required to actually send the bill. A receivable, on the other hand, is unconditional. The only thing you're waiting on is time to pass, so it carries credit risk, the risk your customer just won't pay. It's a really critical distinction for understanding what could go wrong.
Okay, so now let's get to the juicy part, the dangerous side of accrued income. Because it relies on estimates and judgments, it can absolutely be used to create what I call phantom profits. Earnings that look fantastic on paper, but they aren't backed by any cold, hard cash.
And this quote just nails it. The best kind of profits are the ones that turn into cash, and fast. When you see a company whose profits are built on a huge mountain of accruals, that profit is considered lower quality. Why? Because it's just less certain, and probably not something they can repeat over and over again.
So what's the #1 red flag to look for? It's this chart, right here. When you see a company's reported revenue shooting for the moon, but its operating cash flow, the actual cash it's making from its core business, is flat or worse going down, that is a massive warning sign. It's screaming that the profits aren't turning into real money. So how do they do it? How do they create this gap? Well, there are a few classic tricks.
They might pull forward sales from next quarter to make this quarter look good. Or they'll get really aggressive with estimating how much of a big project is done. Some even use something called cookie jar accounting, where they save some profits for a rainy day. All of these bend the rules to paint a much rosier picture than reality.
To see just how serious this can get, let's look at a real-world example that became pretty famous, the case of Under Armour. So back around 2015, Under Armour was a Wall Street superstar. Everybody loved them because of this incredible growth streak. And the company was under enormous pressure to keep delivering at least 20% revenue growth every single quarter. The only problem was, behind the scenes, demand was actually starting to slow down.
So what did they do? Well, for 6 quarters in a row, the company pulled forward an unbelievable $408 million in sales. They were literally borrowing revenue from the future to make the present look a whole lot better than it really was.
And the tactic itself was pretty simple. They just went to their big wholesale customers and offered them deals to take shipments early, months before they actually needed them. This allowed Under Armour to book that revenue now. The problem, they didn't tell investors that this growth wasn't real organic demand. They were just gutting future quarters to hit their numbers today.
And the fallout was huge. When the truth finally came out, the stock just collapsed. Under Armour ended up paying a $9 million penalty to the SEC, but on top of that, a massive $434 million settlement to the investors who had been misled. It's just a brutal reminder of the real-world cost of these phantom profits. Okay, so how can you take all of this and use it to become a smarter investor, a smarter analyst, a smarter business owner? It really just starts with knowing what to look for.
Here's your toolkit. Number 1, always check the cash. Compare profit growth to cash flow growth. If they're going in opposite directions, you have to find out why. 2, keep an eye on the balance sheet. Look for any sudden spikes in those contract assets. 3, question things. If margins are suddenly getting way better for no obvious reason, be suspicious. And last, and this is so important, read the footnotes in the financial statements. That's where they have to tell you their accounting policies, and it's often where the real story is hiding.
So here's the bottom line. Revenue is never, ever just a number. It's the end of a story that's been told using accounting rules and estimates. So the next time you see a headline about record profits, I want you to ask yourself, am I just seeing the final number, or do I actually understand the real story of that company's cash? Because asking that question, well, that's the key to true financial intelligence.